So the area of sustainable finance, I think, has grown in prominence probably exponentially, I would say, in the last 2 years. In my many years in the field now as a practitioner, you haven't seen the level of interest that has been placed in sustainable finance probably that has happened in the last 2 years. It's an area that's been growing over a number of years. And broadly, if we look at assets under management, has been growing substantially over the last few years in the time that it has been tracked. It's an area that poses a lot of opportunity that we're looking at saying is a pivotal area for helping us to achieve sustainable development ultimately, because that's really what we're aiming for with this, but also an area that has different perspectives in that in some areas has been considered as being a lot of greenwashing that is going on, credibility and questions that come into issue. But all of our panelists here today, I think, are people who have worked very hard to ensure credibility in the space, who have ensured to work that we can actually use sustainable finance as a lever to help us achieve sustainable development. Greg, let me start with you. Could you give us a little bit of a background on what are the different types of products and asset classes that we consider in sustainable finance?
The traditional products are typically across capital markets and loan markets. On the capital market side, green bonds, social bonds, and I guess more recently, sustainability-linked bonds. We have seen a significant growth in certainly in the South African market, and it's largely aligned with what we're seeing internationally, just an exponential growth in the market. On the other side of the debt market, looking at loan markets, similar trends here. So on the green loan side, social loans and sustainability-linked loans, there's been a significant interest, particularly from the South African corporate client base, on the linked products right across different sectors. But we're seeing also development in early shoots of interest and I guess product innovation more broadly across wholesale or corporate investment banking products. So definitely interest in looking at sustainability overlays on derivative instruments, ODC instruments in the derivative market. On the supply chain side, so sustainable supply chain financing, working capital type facilities, etc. So really, I guess in line with what we're seeing in other markets more globally, we are seeing a development of sustainable finance products and product innovation into these areas. And then the final comment I would make is, I think there's a huge opportunity for us in transition finance specifically, and certainly in South Africa, given I guess the coal base of our economy. So let me leave it there, and thank you, Shameela.
I can just give a quick overview on the equity side, if that's helpful, is that what we're seeing now is looking at sustainability as it is concerned with the entity as a whole. So whilst we're seeing on the loan side and the bond side generally what we call these use of proceeds model, where you ring fence what you're borrowing and you're using that to actually support very specific projects which have been tagged as green or social or sustainable. What we're seeing on the equity side is that more we're looking at the entity at the entity level, and how does that qualify? So this is where we're looking at things like ESG ratings and the like, or even companies that are looking at it's called automatically green. So if you might be, for example, in renewable energies, notwithstanding some of the criticisms about part of the supply chain, possibly, what you're doing is fundamentally contributing sustainable development. And so at the entity level, you're accredited as being green. And so we've also seen there where there's been a lot that's been happening in terms of mergers, acquisitions, financing of companies that are automatically green, and where a lot of attention is being paid by investors at the entity level looking at the ESG ratings. Now, just to qualify that, with ratings themselves don't necessarily mean that an entity is a good practitioner of sustainability, because often these things are disclosure driven. So that is a part of where we're seeing developments now on looking at just how credible these ratings are, what they're looking at under the hood, and the whole aspect of rating and things like that is getting a lot of global attention in the regulatory context as well. So we have on one hand on the capital markets the debt side, which Greg has unpacked for us quite well, but then on the other side is also the equity side, to say at an entity level, what is the firm doing and how does that look in relation to meeting the kind of development challenges we have when we consider sustainable development and the like. But can banks and financial institutions of all sizes and different market focus areas create sustainable products? And maybe you can share with us a little bit about how Nedbank has been approaching that.
To create sustainable products, an underlying intent to make a positive difference and a positive impact should be present. And this then becomes your driving force and purpose upon which to create products. I think secondly, it's the ability to innovate and to rethink your current existing product set in terms of design, in terms of how can you embed features and look at credit through different lenses to really unlock those sustainability objectives. And thirdly, the development of frameworks and the application of market principles serve as really important tools upon which to enable sustainable products. So if you look at these three ingredients, purpose, innovation, and frameworks and tools, this can be universally applied across financial institutions of different sizes, and it can be applied across different market contexts. And very much so, the context of the market itself can serve as a good guidance framework upon the problems which need to be solved and another input into product development.
If we look at the evolution of the market, specifically with regards to demand, I think originally a lot of the demand was driven by the DFIs. So obviously they've always driven a very strong, sustainable, green ESG agenda, and that's been there for a long time, and I think that's still present today. What we are seeing, and obviously, a couple of yourself and Greg have touched on it, there's also the equity side of things. What we've seen is equity investors have had a stronger focus very much on ESG, trying to understand kind of ESG risks, trying to understand the elements around stranded assets, what are a corporate's transition commitments, and how does sustainable finance and sustainable finance products show commitments in that direction of travel aligned to this. So, those are two of the elements that I guess are driving demand. And then the third one is obviously the debt investors. So the debt investors, we've very much seen a change in tune over the last few years. Internationally, I think, there's been a very, very strong focus by debt investors on sustainable finance instruments, whether it might be green bonds or social bonds or sustainability-linked bonds or even loans as well. Locally, over the last year, I think we've seen very much an uptick in our local investors and their appetite for these type of instruments. So if I look at back 3 years ago when we were talking to specific investors around ESG, they were very much looking at very much more from a kind of exclusion aspect, rather exclude arms and ammunition, potentially exclude tobacco, rather than looking at specific asset classes like sustainable finance. Now, when you speak to debt investors, they're very strong on ESG. They understand the underlying instruments, and they specifically ask around the KPIs. So, for example, if we bring a sustainability-linked bond to them, they'll want to make sure that KPIs and specific targets are of international standard. 3, 4, 5, 6 months ago, when we did, for example, the first sustainability-linked bond, it was a very different discussion. So the discussions were very much more around, what is this instrument? So I think there's been a lot of evolution and a lot of growth in the market. Then on the supply side of things, I think we've seen strong supply coming from listed corporates. Obviously, listed corporates kind of cross-referencing the equity investors that are under pressure to make sure that they're moving in the right direction. They've made certain commitments, whether it's net zero commitments, being carbon neutral, and they've got to be shown to be moving in that direction. And obviously, sustainable finance products are an enabler of that. And it's listed corporates and the REITs. So the real estate investment trusts as well are very focused on that. So I'd say those are the kind of key kind of demand and supply areas that we're seeing at the moment. But to be honest, this area is evolving on a daily basis. So there's new products coming in, there's increasing demand, and there's increasing supply as well.
And on the point of investors, let me turn to you, Heidi, a little bit. So why are investors looking at this?
So I think from an investor side, kind of speaking to a bit of what Nigel was speaking to, is that there is this progression and this change. So traditionally, it was very much a risk-return consideration. But over time, it's really become, how do we become a responsible investor? How do we become a sustainable investor? And, some that are really leading, it's really the question of how do we make impact? So it's not just kind of where's our money going, but it really is the question, what is our money doing? And how does it help society and the planet, given kind of the challenges we're facing from climate change and kind of inequality, especially in the context in which we're in South Africa. So those kind of, that progression is definitely incredibly important. And that's kind of led to lots of investors signing up to things like the principles of responsible investing. So there's kind of that growing way of thinking that is kind of started in the market. And I mean, if you speak to investors, they're in very different stages of this journey. So some have embedded sustainability, for a number of years, and it's a very core part of their investment decision process. And some of them are in the beginning of that. So it depends on where they are in the process. But definitely what we see is that everybody's on this journey. It just depends kind of how far along you are. So, I mean, I think investors are starting to get comfortable with sustainability-linked instruments, but kind of depending on how much information is disclosed in these bonds that are coming to market, what are the benchmarks? How do we objectively assess that this is really good? Or how do we know that this kind of instrument is helping the client do more than they would have done anyway? Or is this just helping the status quo? I think these are the questions that investors are asking sometimes, and that's kind of some of the pushback to say, does it shift the needle? Or is it kind of just enabling BAU? And I think that's an incredibly critical question that also, I mean, us as practitioners on the panel, I think that's what we need to face all the time. So I think that's kind of some healthy skepticism as well to say, the climate crisis is a crisis. And if we're just helping somebody move incrementally, then will it really make a difference? I don't know. So I think there is some skepticism from some parties.
We've also announced a green bond, in fact, last week, and in the roadshows that have taken place this week. And I can absolutely confirm that there's a huge amount of investor interest in the product that has application in renewable energy. But my sense is that there is a bit of a supply-demand imbalance, and I think that will translate into we certainly hope so, a wider and deeper investor base, but also should translate into some pricing benefits. To tie into what Heidi's just said, I do think that pricing differential, or the greenium, or whatever you want to call it, in the linked markets is not as pronounced, and that could well be for all of the reasons that Heidi has said. And I think that's an evolution as well. But certainly my view is that in the use of proceeds side of things, whether it's green or social, there's absolutely, a benefit to issuers in bringing those type of instruments to market.
Tanya, let me move to you. The work that you're doing with the Global Investors for Sustainable Development Alliance, that we know that is focused explicitly on looking at closing the funding gap for the sustainable development goals and saying, how do we bring the power of the financial markets to bear to close that gap, which is probably over $1 trillion, I think between $1 and $3 trillion a year, if we're looking at that.
In terms of the Global Investors for Sustainable Development, so just a quick explanation of what they're doing, it's really trying to channel these funds. So there's no lack of funds, there's no lack of money. We're just struggling to figure out why is it not going to where it needs to be. So the aim, or one of the aims of this alliance, is to figure out what the barriers are and try and channel the funds. And a couple of interesting points came out of it, probably not, unsurprising, but essentially you've got so many players in this space. You've got, governments, multilateral development banks, the big asset managers, the retail banks, etc. And everyone has a role to play. But their risk appetite and their country appetite and their forex appetite and their returns appetite is all different. So it's quite difficult to then get to the scale that we need for sustainable development in the developing world. So what the fund is trying to do is create a blended finance model where the multilateral development banks will come in. You'll get this concessional financing where you're balancing and trying to de-risk so that the retail banks can come in. But the biggest aim is scale, because these little projects happening everywhere is not going to get us to where we need to be. So we're very excited about what's happening with the GISD, and we hope in the next couple of months that fund will be launched.
In dealing with these issues and these challenges, what is the role of innovation and how is that shaping up in sustainable finance?
Now, there's been obviously lots of innovation in the green space. I'm talking more from a technology perspective. So there's been a lot of work done in renewable energy and battery storage and green buildings, electric vehicles. There's strong focus on kind of future technologies as well, as like green steel using hydrogen rather than coal, and green cement, sustainable aviation fuels, carbon capture and storage and the like. So there's a lot of these technologies that are now being developed, a lot of R&D being spent. And what we as financial institutions need to be doing is to say, how do we consider these from a bankability perspective? And how do we as financial institutions manage the technology risk against the missed opportunity. So in other words, how do you manage not financing the next growth business because you're not entirely comfortable with the technology? So, innovation in this space is important, and financial institutions are going to have to look at this through a slightly different lens to the way we've looked at certain things in the past. What we are seeing is a lot of innovation in this space, but I think it's beyond just the loans and the bonds as well. We're starting to see innovation beyond that into kind of, for example, the pre and post trade space, looking at what investors and asset managers are trying to understand kind of ESG risk in their portfolio. We put together, for example, platforms that allow asset managers to understand a company's ESG score, how does that translate into a portfolio, whether they want to look at specific elements like, for example, carbon intensity in a portfolio. So innovation is key. I think we're going to see a lot more innovation in the next year or two. And I think there'll be continued innovation in the short to medium term in this space.
And speaking to what Nigel was speaking to around innovation, I think as a bank, we're obviously very constrained by what our capital requirements are. So if there's these innovations such as electric vehicles or green hydrogen and all these things, which I completely agree, we need to find a different way and think about to finance them. Because they're seen as more risky following the traditional banking model, we'd obviously be required to hold more capital against them, which makes the interest rate more expensive, which kind of leads to a little bit of a, in German we'd say Teufelskreis, like a spiral of things that you don't want to happen. So we have to break that. And in that way, like sometimes the regulations that we have to operate under as a bank can also be constraining, just kind of in enabling that just transition that's so incredibly important.
Arvana, a great point to stop and ask you a little bit about how do we avoid greenwashing?
We understand that clients are at various points in this journey, so it's not a perfect world that we live in, but as long as we're moving the dial forward from a point of departure that remains very credible by adding systems value in a manner that's a shared value and still remains commercial to all parties, but can be measured, can be quantified, can be backed up and has a solid basis. I think that's how we mitigate greenwashing. So it really comes down to due diligence, and even when we're using these external service providers, really understanding that methodology, looking at the track record, looking at how what does the assessment entail, and challenging each other and challenging ourselves all the time. I think very important as well in systems and processes, really, especially under the use of proceeds application, for example, ensuring that we set ourselves up in a way that we can notionally follow that money, and importantly, look towards more forward-looking solutions.
Is sustainable finance doing what it needs to do? Is the money really supporting sustainable development? So we've listened to the different points here. How are finance products catering for the social and the natural issues here? So we're looking at things like biodiversity, social sustainability, the just transition, which has already been mentioned. I know I've given you a big ask there, but just very quickly from your perspective, are we really supporting these things? And if so, how?
Sure. So Shameela, I think it's easier to see how we're impacting and helping from the environmental perspective, not from a biodiversity perspective. I think we need to do a lot more work going forward on that side, but certainly from a climate perspective. From a social perspective, I think we need to be a lot more creative. Too many corporates are just looking at their own diversity, as an example, and going, okay, well, we'll just appoint more females on the board, and now we've met that. For me, what's exciting is what you can actually do through your businesses, through these types of loans and bonds, etc. So, for example, in our UK business, we did a sustainability-linked loan with a company that does learning and development and training. And it was linked to 4 KPIs, and those KPIs were very specific around diversity, gender, from a gender perspective, from a ethnicity, from a disability, and even from a youth perspective. And that's where, as banks, we can have a much greater impact.
Everybody talks about, are we doing enough from a sustainable finance perspective? Are the proceeds going towards green? I think some of them are, but that's not always the objective. The money doesn't always have to go to green. To the extent it's for an underlying asset, yes, that's fine. But it's more a case of us trying to help a company that's trying to understand what they are doing, so where they're trying to measure and monitor, and then trying to move in the right direction. It's almost helping them in that journey as they move towards being net zero or whatever it might be. So I think from a sustainable finance perspective, there's massive opportunity in this space. And I think, all corporates should be considering this in one form or another.
And I would say kind of the social side, I think a part that we're playing in, which in my mind is a huge part of sustainability, is really enterprise supply development. Kind of these corporates, their supply chains, if we localize those supply chains and if we help those small businesses kind of in that way, I think it's incredibly impactful in its own way and is sustainable finance in its own right. So those sorts of things, affordable housing, in my mind, that kind of really starts ticking the sustainable development side, because as we enhance job creation, that impacts families, that impacts lives, that's really impactful.
So if you have a look at capital flows, I'm very encouraged that there is more money generally going towards the SDGs and climate. I think as kind of African banks, we've got a critical role to play in closing the infrastructure gap, and I think I think sustainable finance has an important role to play there as well.
Sure, I think sustainable finance is going to be our lever to drive sustainable growth, especially in the context of our country. And if we can use sustainable finance in a manner that helps reduce the risk in the system, and that impact that we create actually feeds into risk mitigation, then I think we're setting ourselves up in a manner that can only allow us to flourish into the future. So it's an extremely critical lever for us to move forward in South Africa as well as Africa, and definitely to tap into those pools of liquidity and partnerships and platforms and products to ensure that we can unleash as much commercial and sustainable value and impact simultaneously.